Welcome back. We're concluding our discussion on advanced gold explorers and developers. I'm here with Mickey Falk from Mercenary Geologist and Rod Husband from Cipher Research. To recap, we established that the most important aspect of company valuation is the quality, not the quantity of ounces of gold in the ground. The basic equation to follow is value equals number of ounces in the ground times their value. We discussed how Mickey and Rod benchmarked this value. We established that not all ounces in the ground are created equal, and a technical report must be scrutinized, and adjustments should be made where necessary. Now that we have established and discussed both variables, let's put them together into action.
The chart we have on the screen now shows the history of the company that we mentioned in the last video. Started in 2005 and was taken out in late 2013. It began life at 50 cents as a shell and was eventually taken over at $3.75. Now that represents a 7-bagger over a 9-year period and sounds like a good return on investment. But it's not as simple as that. As we've mentioned, there's nothing more than speculative value of this company until its initial resource was established in early 2008. On the chart we show green circles which illustrate what published resources valued at $90 an ounce, and then engineering level feasibility stage NPVs would be worth on a per share basis. And as you can see, it's seldom traded at those levels.
Why would anyone pay $13 per share if it was ultimately sold for $3.75 per share?
Well, to understand that, we have to look at share capital. So we've gone back from the beginning of this company until the end and evaluated its share capital. So it ended up with around 100 million shares issued, and it had raised $320 million for its career, if you will. That averages about $3.25 per share, and the takeover was actually done at about $3.75 per share. So on the surface, that doesn't look too unreasonable. However, when we dig a little bit deeper, here's what we find. The first 46 million shares in this company were issued for $20 million. That's around a 40-cent average share price for the people that got in at that time. Then the real money, the $300 million after that, was raised issuing 56 million shares. That's around $5.35 a share, and the ultimate takeover was $3.75. So those people essentially lost money. But it gets even worse when you learn that in 2011, 2 of the largest brokerage companies in Canada raised money for this company at $12.80 a share. That meant that they were raising money for a company that had a $1 billion valuation, and very few companies that are still at a resource stage in the world are worth $1 billion.
Would this company have made it into your portfolio?
Well, we didn't create our portfolio until after this takeover had occurred, just in terms of Cipher becoming in existence. But what we did do was run it through our models. And when we make adjustments to value for things like cutoff grades, resource prices used, and potential future dilution, depending on the stage of the company, we show them on this chart as orange dots. And the lines in between those orange dots are really what we would consider the Cipher value range. And as you can see there, almost never did this company trade below what we would deem fair value.
Well, it never made it on my radar screen because it was never undervalued with respect to its peers. Even during the global economic crisis, when it was trading below essentially fair market value, I was focused on many other gold companies that were more drastically undervalued at that time.
Let's recap our discussion on advanced gold explorers and developers. Project is key. The equation to follow is value equals number of ounces in the ground times their price.
The value of gold in the ground does not correlate to the actual price of gold. Benchmark correctly.
The focus should be on the quality of ounces in the ground, not the quantity of ounces. If the quality is not there, count me as not interested.
Once you establish your quantity and your price, you can decide your risk-reward profile.
Too often, the only people that make money are the founders and their bankers and brokers. The retail investor pays a very high price.
As a retail lay investor, make sure your expert is really an expert with technical expertise and experience. And also make sure that he has your best interests in mind and not solely on padding his pocketbook.
Mickey, Rod, thank you once again for the great discussion. For more information on the topic, please visit Mickey at mercenarygeologist.com and Cipher at cipherresearch.com.